Hi, this is Brian with the 2018 third quarter update. At the Retirement Network, we try to reach client goals with the least amount of risk possible. Okay, I have a lot to cover today, so I'm just going to jump right in. We have four main things. We have a midterm election cycle. We have this tariff spat that we have brewing as we speak. We have interest rates, which are always really exciting to talk about. And the fourth, we have the strength of the U.S. economy, which I do want to spend a little bit of time on. So the midterm election cycles typically create a lull in the summer months in the stock market. You have sort of a directionless market, not necessarily uptrending or downtrending. This year we've seen a lot of volatility and a market that keeps trying to go higher. And by the way, this is also the reason why there are Wall Street sayings of sell in May and go away, because of this midterm election cycle year lull. At the end of the midterm election cycle year, there's typically a rally at the end of the year. And I can't say for sure if we're going to have a rally. I do think we are going to have one. And the reason being is that we see corporate earnings higher and continually going higher than they have been in the quarters prior. And that, because the market hasn't really come up that much, that implies there's room to run. So we do think there'll be a little bit of a rally. I don't know how much, but it's a good time to stay invested in U.S. equities. Second issue I wanted to talk about is this tariff spat. And I'm calling it a spat because it's not a full-blown tariff war. This is a very small amount of gross domestic product in the world economy. However, it's something worth noting. First of all, we don't like tariffs at all. We don't think tariffs should exist. The best tariff is one that doesn't exist. So we support the idea of bringing tariffs down at least. Removing them would be the best of all, but at least bringing them down. And the United States does pay a disproportionately large amount in tariffs compared to the rest of the world. And that's been going on for decades, and that simply cannot continue anymore. Hopefully, clearer heads will prevail. Some agreements will be put in place, tariffs will come down, and then everybody else prospers. It's a benefit for everybody involved. The third item is interest rates. Now, we think there'll be 2 to 3 more increases through the end of this year and possibly early next year. And the Federal Reserve has done a good job of not getting overly aggressive, which they have a history of doing in the past. When they get overly aggressive, that slows down the economy. And we don't want to see that yet. We have shifted away from a monetary-led economy, and we are now in a fiscal policy-led economy, which is a nice way of saying a traditional consumer-led economy, which is a healthy economy. And we want to see that continue. Speaking of the economy, we're seeing a lot of strength there. We're seeing very low unemployment. I will say that I would like to see better jobs in those employment rates, but still we're headed in the right direction. The U.S. savings rate, this is important, the U.S. savings rate is much higher than it has been in the past. That's reflective of a strong consumer, and the consumer makes up about 70% of the economy. It's just a good idea to have a strong consumer as much as you can, and that has been led by lower taxes and lowered regulation. Add all these up and it points to a pretty healthy economy. So we are still, we have this nice economic background of a strong economy. So the last piece of this is we'll get into the portfolios now. So that leads us to where do we want to be invested? Right now, we see the United States stocks being the best place to be. International stocks are second. They are a distant second. Third are bonds. You still need bonds in a portfolio. It's the same story for bonds in a rising interest rate environment. Have lower expectations of returns from bonds, but you need them to cushion the volatility from the stock exposure that we have, and if you need it, to create some yield. I always like to wrap up by saying that at the Retirement Network, our goal is to reach client goals with the least amount of risk possible. It is not to beat a benchmark. Okay, stay tuned for our fourth quarter update coming soon, and thanks for joining us this time.